Hey, it's Matt Santagapita from the Santa Knows Best show, and this is Andrew Young from Mortgage Wise Financial. We're going to be talking to him today about mortgages.
Mortgages.
So, Andrew, how do the recent changes from the Department of Finance in Canada affect home buyers today?
The short answer is we have to use a qualifying rate of 4.64%, which is referred to as the bank qualifying rate or the benchmark rate. The benchmark rate is the average of the 5 or 6 major banks across Canada. Currently it's 4.64%. So instead of using, traditionally what we would do is we use the 5-year fixed rate, if that's what the client chose, to qualify the mortgage. Right now, we can't use the 5-year fixed rate, 2.49, 2.59, whatever it happens to be. We now have to use a rate of 4.64% to qualify the mortgage payment to make sure they can afford any rise in interest rates, and or they really want to secure that against anybody maybe going off work due to illness or injury or something like that.
So realistically for the consumer, what exactly does that mean, roughly, call it from a payment standpoint? How does it truly affect people?
If you're looking at a $250,000 mortgage, not a $250,000 purchase price, but a $250,000 mortgage, you're looking at a payment traditionally versus the benchmark rate, an increase of about $200, $210 per month.
Okay. So nothing crazy.
Nope.
It's not insane.
Nope.
But it is still substantial for some people. I mean, $250 a month, you're talking, what's that, $3,000 a year, so decent amount of money, right?
Absolutely.
Cool.
It can knock some people out of the market. So people with maybe higher loans from student debt, maybe some pretty high car loans. They just got a new car loan and their payment's $800, $900 a month. They're buying a brand new truck, whatever it happens to be. So it can erode some of the reasonable affordability.
Cool. And so what's the difference between dealing with a mortgage broker like yourself and, let's say, like a mortgage specialist from a bank or a chartered bank?
Sure. The biggest difference, and just to give you a little bit of background, I've been around for about 11 years and I've worked on both sides. So for about 6 years of my career, I was with the major banks, and for the last 5 years and a bit, I've worked as a mortgage broker. So the biggest thing as a mortgage specialist for a bank, you're only allowed to offer what that particular bank has to offer.
Yep.
Not necessarily a bad thing, it just depends on how competitive they are in the market at that time.
Makes sense.
As far as being a mortgage broker, we have the ability to say yes to a number of different types of clients. We also have an opportunity to save clients a little bit of money by shopping around a number of different institutions and getting that rate down a little bit. And we also get to shop for the best product for the client as well.
Okay.
Yeah, so
Cool.
It can mean dollar in your pockets, or it could mean simply the difference between a no and yes.
Okay. So, and also, I guess in the end, we're talking, much more diverse selection on a mortgage product for the end consumer, I guess, is really kind of a way of summarizing it.
Yeah.
Cool. And how important is a pre-approval for a home buyer? Can you explain that to me?
Sure. Not only for the home buyer, but for the home seller too, or the builder, whoever's selling the house. So, biggest thing about a pre-approval is we just take a look at your credit. We take a look at the income. We even take a look at proof of income. So a T4. Hopefully they have a recent pay stub. If not, we have to ask some questions about that. And we ascertain, is your credit good enough to buy a house? Second of all, can you afford the house that you're looking at? So we want to make sure that they can afford the house and we can actually get them approved before they find a house that they want.
So it makes sense, right? I mean, who wants to go shopping for a home if you don't even know you can afford it, I guess, right?
I think a lot of people like doing that, but they shouldn't.
Yeah, no, I agree with you. Yeah, I mean, I've been in the real estate space for, 8, 9 years now, and for sure, I mean, I'd be lying if I didn't say that, you kind of go off what your client says, that yes, they can afford the home that they're looking at, and then really in the end they can't because there's, that student loan they forgot about, or like, oh my gosh, I forgot to pay that cell phone bill 5 years ago, and I believe I did, and I've been arguing with the telco ever since. So, great advice.
The other thing too, if I can just add something else to that too, when it comes to rate, this year 2016 was fantastic. You didn't really have to worry about rates going up, going down. They were fantastic all year round. In this sort of rate sensitive environment, with the changes and with the increase in funding expenses that the banks are having, the rates are going to start going up, and you're going to see some some variance with the rate. So this type of environment, it's important to get a pre-approval because you can lock in a rate.
Okay.
So with most pre-approvals, you can lock in a rate for 120 days with most of the lenders that I deal with. So that means that'll be the highest rate. So if in January, February, the rates go up to, 2.8, 2.9, 3%, and we locked in for 2.5% right now, you actually don't pay anything higher than 2.5. So it sort of insulates you from any rising interest rates.
Speaking about interest rates, where do you see interest rates going short term and long term? So short term, let's say within the next 12 months, call it 6 to 12 months. Long term, 3 to 5 years.
Sure. There's a long and short answer to that, just like with most questions. Short term, in the next 3 months, they're going to go up probably 0.3% or 30 basis points as a minimum. You're probably going to see that over the next 8 to 12 weeks. When it comes to the springtime, you always see a little bit of a dip when it comes to the hottest time of the year to buy. That's when all the lenders are looking for market share.
Yep.
So the best way to get market share is by having the lowest rates, more volume of business,
Makes sense.
higher market share. When things get a little bit too hot and they can't maintain the volumes that they have, they just increase the rates a little bit to slow the market down. Long term, variable rate still pretty good because there's no inflation right now, so the employment feels not that great. Can't really have too much of a rise in interest rates as far as prime rate is concerned.
Yep.
Can't really support that, so that's going to stay relatively low. The more expensive funding gets for the banks, they're going to pass that on to the clients, of course, because the trillions of dollars they make is not good enough. So they'll float it down to the buyers.
Yep.
So they'll be probably close to 3% by the springtime, I imagine.
Cool.
Yeah.
And what if I'm a home buyer and I'm out shopping for a home, and let's say that house needs a little bit of work? We're not just talking a can of paint. I mean, that's pretty simple for someone. We're talking, like renovations, new flooring, maybe a kitchen renovation, a full reno in a basement. What kind of options exist out there for the consumer?
Sure. The best thing to do is a purchase plus improvement, there's no doubt, and it's pretty easy to facilitate. So basically what you do is we get some quotes from some general contractors or the different contractors themselves. So if you're looking at paint, we need quote for painters. If you're looking at getting some plumbing done, quote from plumbing, or if you're getting a general contractor to do it, just an overlay of the work you're going to do and what it's going to cost to do
just
that.
like an estimate of here's the work, this is what it costs at the end of the day. That's what the lender needs to start with.
Absolutely.
Okay.
So what we do is you take the purchase price and then you add the cost of the improvements, and then you take that as basically your purchase price.
Yep.
So then you have to have the down payment to reflect that. So if you're putting 5% down, it's going to be 5% down of the inflated amount.
Okay.
Okay. Now you have to cover the cost of the renovation.
So we're talking the purchase price of the home plus the additional cost of the renos.
That's correct.
Okay.
Cool. So if you're putting 5% down, now it's the 5% of the higher amount, 10% of the higher amount, and so on and so forth.
Okay.
You have to carry the costs of the renovations. So line of credit if you have it, beg, borrow, steal.
Mom and dad,
friends, really
neighbor,
good friends, whatever
whomever.
you can. Whoever has the money, go ahead and get it. And once the renovations are done, then we send an appraiser out to make sure all the renos are done, and the money is returned to you through the lawyer.
What kind of time frame does someone have? Like, is this you can take a year to do it? Do you have a month? Like, what does that look like? I'm sure everybody has kind of a different.
Most lenders
different
like to see
guidelines,
things
but-
done in 90 days, but
Okay.
I've seen.
So 3 months though, that's not that bad.
Not bad.
That's
I've
a
seen-
reno.
I've seen people hold on to it to a long time.
Okay.
And the banks start knocking on the door and be like, "Did you do the renos yet?"
Yeah.
But more often than not, it's 90 days. They want to see the work done.
Cool.
Yeah, and most people want their money by then.
Well, I guess obviously, right? You start, especially you start throwing it on a line of credit. I mean, you start making those payments. So really, then, yeah, I mean, you want to get it done.
Absolutely.
Now, I guess in a case like that, is there any option? Like, does the contractor have to do all the work? Can the homeowner do a little bit? Can it be a mix? I mean, I'm assuming, obviously you want permits to be done if you're doing electrical and plumbing, that kind of work. But, let's say I'm a really handy guy and I can do carpentry work. Can I do my own trim and hang my own doors in my basement that I'm adding? Like, are those options
as
there?
long as it's done and it's done properly, there's no way you can just put a camera on and record and make sure that licensed professional is doing all the work. So as long as the work is done in a proper, safe fashion,
Yeah.
and it's adding value to the house, then it's not a problem as long as the work is done.
Awesome.
Yeah.
Cool. One more question for
Sure.
you. As a home buyer, what can I do? What are my options to, let's say, pay down my mortgage faster?
Sure.
What can we do as a consumer to shave off some interest payments, maybe a year or two? What options exist for us?
Absolutely. Most lenders offer what's called prepayment privileges, right? So PPP. Rubber baby buggy bumpers. Most lenders offer what's called a prepayment privilege, or
Okay.
an extra payment, right? That ranges anywhere from 10% to 20% per year. And there's
Okay.
two different ways that you can do it. Some lenders offer an opportunity to increase your payment. So if you have a monthly payment, you can increase that by 10 to 20% per month. That extra money goes directly towards the principal of the mortgage.
Mm-hmm.
The second way to do that is by making lump sums, okay? So you can make a lump sum, any regularly scheduled payment, up to 20% of the original principal. So if your mortgage is $250,000, you can make an extra $50,000 extra payments per year.
Per year. Okay, so
Per year.
it doesn't change
Nope.
as you're paying off your mortgage. It
Nope.
stays the same based. Okay.
That's right. You can make those payments a couple of different ways. You can wait for the anniversary date if you'd like. You can make extra payments every regularly scheduled payment. Minimum payment, extra payment is generally around $100 or more.
Mm-hmm.
So you could actually call the lender up and say, hey, next payment, $1,500 off. Or next payment, hey, can you get me an extra $2,500 off?
And the benefit in the end for the consumer is what when they do that?
You're going to save a lot of interest money because as you pay your principal down, you're paying less interest because that's how you calculate what your interest is going to be.
Cool.
Yeah, so you pay down the principal, you're going to pay a lot less interest.
Awesome.
Yeah.
Awesome. Well, I want to thank you, Andrew Young, for spending time with us today. Just so you know, Andrew Young is from Mortgage Wise Financial here in London. Personal friend of mine, amazing mortgage broker. He does all my personal mortgages as well. Give him a shout, his link and everything. I don't even know what I'm going to say.
It'll be right here.
Yeah, it'll be right here.
Right here.
We could just pause it.